Nilesh Shetty, who's Associate Fund Manager at Quantum Asset Management, joins us with a quick perspective on one of their prominent funds, which is Quantum Long-Term Equity. Nilesh, good to have you on the show. Give us first your view on the market and how you're positioning yourself with respect to this fund.
Well, the markets stayed at fair valuation. If you look at the long-term multiples, it is fairly similar to, current multiples are fairly similar to long-term averages. Unfortunately, the market rally has been fairly concentrated. You've had consumer, pharma and certain select private sector banks which have led the rally, which have turned very expensive. While the other stocks where there is a significant overhang of earnings visibility, where you have a bit of value left. For us in the portfolio, we have been on fairly elevated levels of cash right now. Our cash levels have been close to 20%, which is fairly high, even compared to our historical averages. We struggle to find stocks with the reasonable valuations within certain key sectors, or stocks which we would like to buy at reasonable valuations. That tells us that at least in the near term, market valuations are expensive for the certain select stocks which we would like to buy, but broadly averages are in line.
Right. The interesting part also is that, in your top holding, sector holding, you have energy and services. Actually, the distribution is varied across financials and automobiles as well, but energy tops the list. Do you think that in a meaningful way, the move is likely to come in for energy stocks, and where is the focus, upstream, downstream companies?
I think we've had an upstream company for a long time within the portfolio. The latest addition was a downstream company. Again, the primary call was on valuations. At some point, given these companies are trading at such a large discount to replacement cost, at some point the valuation kicker would come in. You needed some move from the government in terms of oil deregulation, which came over the last 6 months, and then hence you had a bit of value unlocking there. But there is no sector-specific call in terms of trying to be in upstream or downstream. It was purely a stock-specific valuation call. The last stock that we added was in the downstream segment, where valuations were a lot cheaper.
How do you expect this earnings season to shape up for technology, Nilesh? Because the common belief is that the rupee will aid a lot of these companies. However, the initial reports that have come from the sell side seem to suggest that large companies will probably not benefit, and maybe some of the smaller companies will take the benefits in their books in the current quarter. How do you think the rupee will play out for them? And would the current quarter earnings be robust enough?
So I think there are enough near-term challenges for a lot of the companies in the space. So, but again, the key call that we have taken is valuations tend to factor most of these challenges, and it was valuations which are in your favor right now, and then you would rather add these stocks and you have lower multiples right now than waiting for the earnings to kick in and then trying to buy them at substantially elevated levels. So over a long term, we are fairly bullish on the space. We think the wage arbitrage story remains fairly high, and these companies will scale up the value chain. Near term would be challenging for a lot of these companies. Even though rupee is in their favor, but you never know. Again, if you have a significant upswing the other way, you would be struggling to. Most of these companies would be struggling to retain the benefit of the rupee. So in that sense, perhaps a bit of longer term view on these stocks would be helpful. And at least our sense is valuations currently remain fairly attractive in this space.
So what have been your allocation trends over the last 1 month? I mean, where have you increased allocation or decreased allocation respectively?
So we have reduced allocation in a media company, and we have reduced allocation in a private sector bank. The only place where we could find some value was cement, where we've added a stock to the portfolio. But by and large, most of the other stocks are not cheap and are, at least for us, nowhere near buy levels right now. So we have been sitting on a large amount of cash right now.
And how much would that be as a percentage of the total AUM?
Currently it's about 20%.
So that's interesting. And you're overweight on energy also, I would assume.
Again, it was primarily a valuation call. It was not a sector call. We did not take a call on the sector, but stocks within the sector turned relatively cheap, and we started adding these stocks in the portfolio, and the end sector weight is a reflection of that.
The other, just taking a cue from your answer to Tanvi, Nilesh, if you're sitting on so much of cash, which I'm guessing would be among the higher levels, and correct me if I'm wrong, in the last 6 to 9 months, when do you foresee an opportunity to deploy this cash? Is it waiting for a particular level on the index, never mind what's happening around on the macro with the currency and all? Or do you think those factors would come into place? Maybe a rate cut, maybe the currency falling back or appreciating back to those maybe 58, 57 levels. What would trigger investment of the corpus that you're sitting in?
So we really have no call in terms of what would trigger, but all we know is we do not want to deploy the cash right now, given where valuations are in these stocks. There's a higher risk of losing money than protecting the downside. So the cash is always a residual. If you do not have stocks to deploy money in, whatever else remains is cash in that sense. We hope the market corrects and we get an opportunity to deploy. But we've had fairly elevated levels throughout different market cycles. Even in 2007, we were as high as 35% cash. We lost a bit of the upside when the market was booming in 2007. But when the crash happened, at least the portfolio outperformed because we were sitting on so much cash, and we protected the portfolio from the downside. So the call remains to protect the downside first, and then if you get a stock at your valuations, you go ahead and deploy in these stocks.
Expect a fall in the market over the next, let's say, month or so?
We really have a slightly longer term horizon, so I don't have a view for a month.
Okay, just a quick call on automobiles as well as services as a sector. Where's the focus there?
Automobiles in December 2011 was when we saw real value. We added we added an automobile stock in the portfolio. We increased the weight in automobile stocks because the valuations were very cheap. Once interest rate cycle turned, these stocks turned fairly expensive. They are not sell levels as yet. They are slightly elevated though. They would have sort of increased 75% from the levels we bought them at. So we are just waiting to ride the upside, but they are not cheap anymore for you to deploy money in these sectors.
All right, Nilesh, we'll leave it at that. Thanks very much for joining us and giving us your perspective on quantum long-term equity.